Let's go some more on this day after response to the Dovish Fed. Now, listen to this. Moments ago, former Federal Reserve Governor Kevin Warsh, he was a close confidant of Fed head Ben Bernanke. Mr. Warsh warned out at Stanford that the Fed's record easing may actually impede U.S. economic growth. Let me read you his money quote, and I quote, "Recent policy activism, measures that go beyond the central bank's capacity or traditional, threatens to forestall recovery and harms long-term growth." All right? That's pretty powerful stuff from an ex-Fed governor. So let's talk to an ex-Fed head. CNBC contributor Robert McTeer, former president of the Dallas Federal Reserve. Bob McTeer, welcome back. What do you make? What is Kevin Warsh trying to say? He's saying ultra-easy money, including yesterday's policy announcement, may actually harm the economy. Why is this?
Well, I think he's probably right about that. I think what the Open Market Committee has actually done has been okay, but all this open market talk, all these projections, I think, are far beyond what we need. Mid-2013 was a mistake, and end of 2014 is a mistake, and it's a mistake under the guise of transparency to tie your hands like this, put yourself in a straitjacket.
Is it inflationary, Bob?
Not necessarily inflationary. Everybody has said that what the Fed's already done would be inflationary, and it hasn't been. And it hasn't been because the banks are hoarding excess reserves. As long as that goes on, the easy money policy in the U.S. and in Europe is not likely to be inflationary. And I would pick stocks over gold.
But what about one of the things Warsh is implying is, I think he's saying, when you artificially hold down rates, yes, they control the Fed funds rate, but it influences the whole yield curve, that distorts risk decisions. Is that fair? It distorts risk decisions, may lead to bad investments, which in turn may come back to bite us in the leg and damage the economy. Is that Warsh's point, and do you agree with that point?
I tend to. That's Austrian economics. I also think that 6 years of financial repression is just a little bit long to hold interest rates down close to zero.
Is the Federal Reserve signaling to us that they are willing to accept and accommodate more inflation than would have been the case 3, 4, 5, 10 years ago?
Well, I think a 2% inflation target is a little high, but I think mainly what Bernanke's trying to do is talk long-term rates down, and he thinks if he convinces us they're going to stay down, he doesn't have to do much to bring that about.
Mike Ozanian on our stock panel just a moment ago reminded us the M2 money supply is growing about 10% year on year. Bank loans, by the way, C&I loans, also about 10% year on year. Now, when you're in a deep recession, maybe you don't worry about that. But if you're going to grow at 3% and the Fed's targets are 3 to 4%, maybe there is too much money now suddenly chasing too few goods. Maybe those excess reserves are going to get put in and we'll get an inflation problem. Is that an issue?
I don't think so. Most of that growth in the money supply took place in 2 or 3 months. It's already diminished greatly. I don't think money is growing too fast under the circumstances.
Then what's your beef with the Fed, Bob, just to sum up?
Just too much transparency or too much information, tying their hands with these promises that they may not need to keep, may not want to keep later on.
I get that. Another government agency making promises it cannot keep. That I understand. Bob McTeer, former head of the Dallas Fed, thank you very much.